What's going on, everybody? This is Phil from Millennial Money Gains, and welcome back to a brand new video. Today we are introducing our stock investing course 101. This is going to be part 1, and there was a lot of information. If you guys are happy and like all the content and the value that's given in this course, just please make sure you smash that like button. That's all I ask for you in return. And also consider subscribing to the channel if you do like the value that is being offered in this video. Remember, this is all for free. Everything will be posted on YouTube, and there will be multiple parts to this presentation. But with that being said, let's get into it because we have a lot to go over. Now, this course can be used for anyone, good investors, bad investors, just starting out. It's mostly meant for beginners, but even intermediate and advanced investors can capitalize from this course. So let's go over the overview and what we are going to go over. So first, what do you need to start investing? You need a brokerage account. Now, there are many you can choose from. You can choose from Fidelity. You can choose from Robinhood. Which one do you choose? We will go over that. Then you have to choose. Do you want a retirement account or do you want a taxable account? There are going to be different benefits to each one, and we're going to go over them as well. Then we are going to go over how to fund your account, how much to fund your account with, and more. And next, we are going to look at when you should start investing. When should you invest? Is now the right time to invest? Do you invest once a month? Do you invest once a year, once a quarter, once a day? And let's get started with the course. First is which brokerage should you choose. So we have different ones here: Robinhood, Fidelity, and Charles Schwab. These are the 3 that I chose. There are many more. There's M1 Finance. There are a bunch of other ones. There's Moo. You guys can do your research on those. These are the ones that I am going to be comparing. So first up, we have Robinhood. So Robinhood was the first one to do commission-free. It is the reason a lot of other platforms are doing commission-free as well. Next, Robinhood is very beginner-friendly. It has a very easy-to-use interface, and a lot of beginners choose this one because it is so easy to use, and it's really not confusing at all. And you definitely don't need to know as much information when using Robinhood. Personally, I do use Robinhood for my public portfolio that I show you guys. And I do use another one, which I'll get into after. Robinhood is fast and easy to fund. They give you instant deposits. All you have to do is set up your bank account to it, and you could pretty much have your money sitting there that very second, and you could start investing right away. They also have free options. So this is if you're trading options or if you are selling covered calls, which we will go over later on in the course, but they have free options. A downside about Robinhood, they have a weak customer support. So they did just upgrade their customer support, but it is going to be a while before it's going to match like Fidelity or the customer support of Charles Schwab or these more developed brokerages. And Robinhood also has limited investments. So you're going to find more investments on more platforms such as Fidelity and Charles Schwab because they have more investments available for you to invest in. Robinhood has every basic investment that you will need, but if you want some specialty investments, Robinhood may not be for you. Now let's go over to Fidelity. They are the grandfather of brokerages. I use Fidelity for my retirement account, and I use Fidelity. Actually, I just have 2 retirement accounts with Fidelity. I have my Roth 401k and my Roth IRA. Don't worry, we will go into exactly what those are later on in this part 1 of this course. So next, we have Fidelity is now also commission-free, right? So because Robinhood was commission-free, Fidelity, they came out and said they want to be commission-free as well. Fidelity has great customer service. You are not going to find better customer service, in my opinion, than Fidelity. You can call them up. They're open 24 hours. You can call them up, ask them any questions you have, and you can go from there. But they do charge you for options. Even though they're commission-free for stocks, they charge you 65 cents per options trade. Now, this could be multiple contracts, but they do charge you 65 cents per trade. And next we have Charles Schwab, which is also commission free. They also charge 65 cents for options. They do offer futures. If you are looking to trade futures, that could be something that you are interested in, but for me, I don't need any of that. Charles Schwab and Fidelity are very similar in those regards. The next thing we have to talk about here is the retirement account. So we are going to go over the Roth IRA specifically, but there are other retirement accounts also, whether we are talking about 401ks, Roth 401ks, and regular IRAs. So there's multiple different retirement accounts, and if your job does offer one, such as a 401k, which most employers do at this point, if they offer it, you should be putting into it. If you can choose whether a Roth or a regular 401k, we're going to go over what a Roth IRA is, and then you can choose from there. But you should be contributing to this account, to this portfolio. And remember, just by picking the Roth 401k or the 401k or the IRA, that is just a type of account. You will still need to pick your investments in that account. So let's just go over what a Roth IRA is. So a Roth IRA is an individual retirement account to which you contribute after tax dollars. So you get paid, that's already taxed. Now you could take this money and you could put it in this account. While there are no current year tax benefits, your contributions and earnings can grow tax-free, and you can withdraw them tax-free and penalty-free after the age of 59 and a half, and once the account has been opened for 5 years. The current max contribution is $6,500 per year. So let's just go over the power that this has. So you pay on that, you pay taxes on that money now. So say over the course of your 40-year career, you take $6,500 a year. So over the course of 40 years, you put in $6,500 every single year. You will have contributed a total of $260,000. Now that $260,000 will be taxed already because you already got paid. You're using your tax dollars, your own tax dollars, to add to this account. Now, whatever that grows to, whether it goes to $1 million, $2 million, $3 million, $5 million, all of that money after age 59 and a half will be tax-free. That's the power of the Roth IRA. That's why there's a current max contribution to it. And you cannot have more than one of these under your name. So $6,500, if you have a rollover IRA or whatever you have, you can still only contribute a total of $6,500 per year to this type of account because it is so powerful. And I plead, if your employers do offer any match or earnings match on a 401k or a Roth 401k, which a Roth 401k is pretty much the same as an IRA, only it's company sponsored. As the Roth IRA, you use your after-tax dollars to put into an account, and then it grows tax-free. So I plead you to put whatever they say they match up to. So if they match up to 4%, then put at least 4% into your account. If they match 8%, then put 8% into your account of your paycheck, because that is just free money and there is no need. There's no reason not to do it because you will be denying free money at that point. If you guys want, we can go over more about retirement accounts. It could be its own separate video. I just wanted to include that in here just for some information. But let's move on. Let me know if you guys want to know more about retirement accounts. So now we have our taxable brokerages, right? So this is after you put your $6,500 in your Roth IRA. This is what you would move on to after. So the taxable brokerage accounts, an ordinary brokerage account that is not a retirement account, is a taxable investment account. If you make money because your investments go up in value or because your investments pay you dividends or interest, this income will be taxed. That income will be taxed at that following year. You will receive a form through your brokerage in which this will be taxed. So that's if you paid dividends, if you got paid dividends, or if you bought or sold a stock in the same year, you will then receive that account, either the profits or the losses, and you can claim up to $2,000 a year in losses. So make sure you don't exceed that, but make sure you guys are putting into a taxable brokerage as well. Don't stop at just the retirement account. That account, yes, you need the retirement accounts, but this one is going to lead you to early retirement and financial freedom. So now we are going to move on and go over funding your account. To fund your account, you'll need to transfer money from a linked bank account, such as your checking or your savings. You may also be able to wire transfer money, deposit a check, or transfer investments from another broker. The broker may ask if you want a cash account or a margin account. So we're going to go over in an upcoming slide what a margin account or what a cash account is. But personally, I think it's easiest if you just fund your account with the bank, with a linked bank account, whether a checking or a savings, and you want to put this money in first. This is the money that you are paying yourself. So if we have any fans of Rich Dad Poor Dad here, then you know exactly what I'm talking about. He says you want to pay yourself first because you owe that to yourself. So you put your money into your investment first, and then you can pay your bills. You want to make sure you are doing this first, so that way you make sure that this is being done, and you are probably not going to work as hard if you pay your bills first and then don't have enough money to fund your account. But if you fund your account first and then don't have enough money to pay your bills, I'm sure you will find a way to come up with that extra cash. So we got the cash account and we got the margin account. What exactly are they? Which one should you choose? So let's go over. So the cash account is a type of brokerage account in which the investor must pay the full amount for securities purchased. An investor using a cash account is not allowed to borrow funds from his or her broker-dealer in order to pay for transactions in the account, trading on margin. So whatever, if you have $1,000 and you have a cash account, you can only buy $1,000 worth of stock pretty much. If you have $1,500, you can only buy $1,500 worth of stock. Now with a margin account is a type of brokerage account in which the broker/dealer lends the investor cash using the account as collateral to purchase securities. Margin increases investors' purchasing power, but also exposes investors to the potential for larger losses. So if you're trading on margin, they will give you a loan per se, and there will be interest on this loan in which you can use to buy investments, or you can use to, whether you want to collect dividends, or you can use it to trade stocks. It's a very risky account, so I suggest if you are new to investing, you may want to do the cash account and don't even allow yourself the access to the leverage. You can change whether you want a cash account. Let's just go back to that. You could change whether you want a cash account or a margin account at any point. You can just find that in the settings of your respected brokerage, and you will be able to change whether you want a cash or a margin account. I suggest everyone start with a cash account and only put in money you can afford to lose. When should you begin? Right now. Best time to start is right now. So as we see from this graph here, time in the market beats timing the market. So the buy and hold strategy, if you dumped all of your money in at once, even if you dumped right before the crashes, you will still have the best buy and hold strategy. Because if we see here, I'm just going to move me a little bit, missing the best 5 days, you already lost a percentage on an annual basis. Missing the best 10 days, you're almost down 2% on an annual basis. Missing the best 20 days, you're down about almost 4% on an annual basis. And missing the best 25 days, you are down about almost 5% on an annual basis. So best is to buy and hold if you can in lump sum. Now you may not be able to, or you may not want to, all buy it all in one lump sum. So you can do something called dollar cost averaging, which I think we talk about in this part as well, but we will see, and if not, it will definitely be in future parts. But I think it's in this part. There it is, dollar cost averaging. Time in the market is better than timing the market. So let's go over timeline. This is a graph, just an impact of when you start investing. So it's hard to see here, but Jack invests $200 per month, starting at the age of 25. He contributes a total of, I think that says 95,000. I'm not even sure exactly. Maybe 395,000. I'm not sure exactly what that says. But you can see he started at 25. Jill started at 35. And then Joey started at 45. And you can see exactly. So obviously Jack has the best investment, best portfolio value out of the three of them there. Then Jill, who started 10 years later, is sitting just about 250,000. So almost about $300,000 less. And then you have Joey, who started at 45, and by the age of 65, just sitting at 100,000 or so. So almost $400,000 less than, over $400,000 less than Jack, who started at the age of 25. So age, if you're young, you need to do this as much as possible. I was lucky. I got into investing when I was started, I think when I was like 22. I made a lot of mistakes along the way, so I'm not as far as I would have liked to be. But the earlier you start, the better it is, and the easier it is to make those mistakes, the easier it is to correct them. So that's going to be about wrapping up part 1 here. If you guys did enjoy it, just please make sure you smash that like button. I really do appreciate that. Also, if you can share this with anyone, anybody that you know that could benefit from this, just share this with them. I really appreciate you watching. Check out the description for a link to free stocks. If you want to sign up for these brokerages, you could sign up for WeBull. I have a link down there, and I have a link for Robinhood down there. So go sign up for those. You got free stocks with them, and I do appreciate you guys helping out the channel. Make sure you guys are subscribed to the channel, because we are going to be posting part 2 very shortly. Probably about maybe a week or so after you are watching this one. So make sure you guys stay tuned for that. I do appreciate you all, and I will see you guys in part 2. Stay investing, and let's get rich together.